Mastering the art of risk assessment in investing. Embarking on the investment journey is akin to navigating a vast ocean. While the promise of treasures, or returns, beckons, it's essential to be wary of the storms, or risks, that might capsize our ship. Today, we're setting sail into the vast waters of risk assessment in investing, charting a course to understand and calculate risk value. Deciphering risk. Before we plot our course, let's understand what we mean by risk in the world of investing. In essence, risk pertains to the potential of an investment not living up to its anticipated return. This could manifest as returns that don't meet expectations or, in more dire circumstances, a loss of the initial amount invested. Classifying risks. Systematic risk, market risk, this is the omnipresent risk associated with the entire market. It's the kind of risk that remains, no matter how diversified your portfolio is. Think of events like global recessions, wars, or significant interest rate changes. Unsystematic risk, specific risk, this is the sneaky risk tied to a specific company or sector. The good news? It can be minimized with diversification. For instance, if a company loses a major contract or an entire sector faces a downturn, that's unsystematic risk at play. Measuring risk. One of the most popular methods to gauge risk is by observing price volatility, often using a metric called standard deviation. If the standard deviation is high, it indicates that there's a higher volatility and, consequently, higher risk. For those keen on the exact formula for standard deviation and how it's derived, there are numerous tutorials available on YouTube that delve into the specifics. Beta and its significance. Another critical metric is beta. It measures how a particular stock moves in relation to the overall market. If you're curious about the exact calculations behind beta, a quick YouTube search will provide a plethora of detailed explanations. Value at risk, VAR, explained. VAR, or value at risk, is another essential tool in our risk assessment toolkit. It offers a worst-case scenario with a specific confidence level. For instance, if you have a one-day VAR of 1% with a 95% confidence level, it implies a 5% chance that the portfolio's value will drop by more than 1% over a day. The precise calculations behind VAR are intricate but can be easily found in dedicated YouTube tutorials. Evaluating risk-adjusted returns. After quantifying risk, it's pivotal to juxtapose it against potential returns. This comparison aids in discerning whether the possible returns are worth the associated risk. Two commonly used metrics in this realm are Sharpe ratio. This metric evaluates the performance of an investment against a risk-free asset, factoring in its risk. For a deep dive into its calculation, YouTube is a treasure trove of information. Sortino ratio. This is akin to the Sharpe ratio but focuses solely on downside risk. It's a boon for investors keen on gauging the potential for negative volatility. Again, for those mathematically inclined, YouTube offers a wealth of detailed breakdowns. The power of diversification. One of the most potent weapons against risk is diversification. By allocating investments across diverse assets or asset classes, the specific risks tied to individual investments can be diluted. It's the investment world's version of the age-old wisdom, don't put all your eggs in one basket. In conclusion, risk is an intrinsic facet of the investment landscape. But, with understanding, measurement, and adept management, investors can make enlightened decisions, aligning their investment strategies with their risk appetite and financial aspirations. It's less about evading risk and more about embracing calculated risks where the potential rewards outweigh the possible pitfalls. As with every facet of investing, continuous learning, staying updated, and periodic portfolio reassessments are the cornerstones of enduring success.